A massive week for the US dollar and markets because we have the FOMC rate decision and US jobs data. Big reactions expected. Guys, Ken Chigbo back with another E8's market fundamental update. Let's jump straight into this. Okay, traders, we are back with another week in these beautiful markets. And boy, are we in for a treat because, as I say, it's a big one. Look at the docket. Look at the high impact data that we have here going on. It's chunky, right? We've, of course, the real center point comes with the FOMC. Now, the large consensus is that we're not going to get a rate cut this meeting from FOMC. No. They've communicated that extremely clearly to the markets. The volatility comes with September. Markets are expecting rate action, rate to start being cut in September. It's not 100% priced in right now. So the communication from Powell is going to be very, very defining for whether or not that September is going to be 100% likely, or nothing's a given anyway. But if that's going to be very likely, and we're going to see some further potential dollar weakness, if Powell is very much sort of dovish and positioning for that and leaving the door open for more rate cuts, that's the key as well. So the volatility comes with Powell's language as to whether we're going to get that cut in September. Okay. And then thereafter, what happens after September, the other months? Are we going to see more rate cuts? Is it going to be a case of one and done, or are we going to see a few? Because really, to see that pickup of dollar momentum, Powell needs to be dovish. Okay. Him being dovish, I think, look, at the end of the day, inflation's still sticky. Look here on my screen. Okay. Remember those weeks ago, we went over this. Obviously, with Forex Factory doesn't show the full view of pictures, but even if when we look at core year-on-year annualized, so we've got the annualized number here, year-on-year, 2.7%. But when you look at the core as well, that was elevated. So inflation still remains elevated on annualized level. Remember, they want to bring down inflation, but the fact that it's still high, they need to keep rates higher in order to try and, bring down cooling of spending. So then obviously price of goods and services naturally start to come down. So it's sort of short-term pain for potential long-term gain. But the economy is at that stage where it needs rate cuts. We are seeing a softening. We are seeing a slowdown. Remember that previous GDP reading had a massive contraction, as you can see here, of 0.5%. We're seeing less jobs being added to the economy. We're seeing that naturally on the decline now. The average earnings, wages, what people getting paid, cooling. So all of this is deflationary. The reason why inflation is so sticky right now in the United States is because of, why? Tariffs. Now, if we just take a look here at dollar, okay, dollar, as we know, structurally, been going over this for quite some time now, remains very much to the downside. We've been printing lower highs, lower lows, all that good stuff. And arguably, not last week, the week before last, we've printed a new lower high, subject to doing what? Producing a new lower low. So quite clean right now in terms of the structure being respected. Obviously, we've got this key demand zone down here at sort of 96.50, 96.00. If that ends up giving way, we could see some selling pressure. Now, that could happen if we get Powell pivoting, gearing the markets up for those rate cuts. I say cuts with an S, plural. And obviously, what would further ignite this dollar selling pressure is if we get a softening of data. But that's very, very important. That is also helping shape up expectations for rate cuts, okay? And action that's going to force the FOMC's hand, force Powell's hand to actually cut, and then he'll do what's desired by Trump. Trump wants these rate cuts. So let's keep an eye. GDP data, very important. This is the advanced reading. Obviously, the previous quarter, we'd seen a massive contraction there, slowdown. Okay, we've got the Fed's preferred measure of inflation, which is expected to be sticky, which we know. If that shows signs of cooling, that's going to trigger some dollar selling. Any of these other labor market figures are very, very important because that could just feed into the narrative and help, as I say, force that hand of Powell for further rate cuts after September as well. Okay, so this is a real defining moment. If we look at the moment, I'd say things are still leaning toward dollar bears. Okay, and structurally, technically, this is still vulnerable to some further selling, but buckle up, guys. Aussie dollar. We have key inflation data from Australia. This is a very, very important one, guys, okay? Look here on my screen, quarter on quarter and year, CPI, trimmed CPI. These numbers, generally speaking, okay, the quarter on quarter is expected to cool down to 0.8%. The other figures are expected to remain sort of pretty much in line. Inflation is one of the key reasons. That's the only reason. Well, inflation has come down towards their target, right? They have a target range of 2 to 3%. Michelle Bullock is still hawkish. You know, her last rate decision, she didn't cut rates. And markets were expecting those rate cuts, which is why AUD had actually strengthened initially on that. But when we look at key data now, we have seen a cooling in the labor market, right? Worsening in terms of the amount, the employment change there. And in 2000, the unemployment rate jumped up from 4.1% to 4.3%. So we have a case. There's a rising case for the RBA to start cutting rates. Okay, resuming rate cuts. But we need to see inflation, okay, softening. Perhaps, look, we see that, you know, the poor labor market data there. We've got rising unemployment, obviously less people in the workforce to be spending money, stimulating the economy. Perhaps that filters through in this reading here. Perhaps it may be too early. It may be too soon, okay, to see those effects being filtered through. But we got to slow down there. In terms of if we look at AUD versus dollar, look, if these numbers call, let me just give you the scenario with AUD, okay? I'm going to look at AUD USD as a base case. We'll look at another Aussie pair as well. But if these numbers come out higher, expect AUD strength, okay? There'll be AUD strength. If they call, I expect them to call. If these numbers call, then expect AUD weakness. But obviously, versus the dollar, things are a little bit tricky because obviously we've got all these risk events with the dollar related. So it may not be the best one to particularly trade if, for example, we do get, out of line data there. So give me a moment here. Let me just... Okay, so when you look at AUD USD, we are still in an uptrend. We've been printing higher highs, higher lows. Can you see? Very clear structure. You can see that on the daily. Higher highs, higher lows. But it's a very tight one, you know, in terms of this move. But the structure's there. Okay, we're moving this rising channel. If you still ask me where we're going, I mean, if we're paying attention to structure, it remains intact. You'd expect that to continue to the upside, but an element of caution. So long as this channel remains expected and that data surprises and comes out sticky, then AUD USD can push higher. But then the dollar weakness, if we have dollar weakness, you see how there's so many variables this week. The dollar weakness may offset that. What I'll be interested in is keep an eye on Euro Aussie. Okay, Euro Aussie is an interesting one because structurally we've been to the upside. When you look on the very higher time frame, the monthly, right, we've been printing higher highs, higher lows. We've got this big wick here in April, which we'd like to see filled. The fundamentals are more sound in the Eurozone, a little bit more stable. Structure is to the upside, especially in this latest move here on a weekly. After this pullback here, we're sort of falling back in line with structure. And we didn't break out of that structure because we had the higher high and this was a higher low, still higher than this low here. Okay, and now we're on the ascent again. So structure is still intact. We had a moment of fake out there from this trend line and this structure. High, 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 low, high, 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 low. You get the point. We are structured to the upside. We just had this period of consolidation. But we had this reversal candlestick, closure above. Okay, on a weekly, still remains bullish. We'd expect a continuation. But we've got this heavy area of supply that we need to break down at the mid 79 region. In order to carry on, we need to break that down. And then we could do this, and then we can fly. There's no reason as to why that can't fly. But so long as this AUD data, this CPI data does call and rallies up the market expectations for rate cuts. Elsewhere, we have the Bank of Canada rate decision where, to be honest, I think this is going to be a non-event. I don't expect any fireworks here. These guys have been on pause for a while. And the reason they've been on pause because inflation in Canada, let's bring up some inflation data. Inflation's remained sticky. Look here, year on year, 3%, 3.1%. They want inflation down at 2% on annualized level. So this is the sole reason they stopped cutting rates. Because remember, they were one of the most dovish central banks. When you look here, they were cutting quite aggressively, okay, quite quickly. You know, from 5 down to almost half the rate, down to 5.75%, 2.75% so quickly. And now they're on hold because of inflation. But bear in mind, growth in Canada, they're essentially on the brink of recession. We've got a potential negative reading coming here. And if anything, it's like a case of the central bank's hands are tied right now. And it's similar to the FOMC, but this case is a little bit more negative because we really do have negative growth. I mean, the US does as well, but more so Canada, and they're so vulnerable to the tariffs, the developments there, whatever happens. When you look at dollar CAD, it's not the best one to trade right now. I think we're going to be in a range for a little while. You can see on the weekly, we've been ranging anyway. Since the night week of 9th of June. There's no commitment. We're moving within this channel. I mean, it's still leaning towards potential downside because structure is to the downside, lower high, lower low. Structure is bearish, and eventually maybe this is a bearish flag and it plays out and we get that breakout to the downside. Okay, we covered this previously on the stream, but yeah, just a bit of a hand sitting here with particularly dollar CAD. Obviously, you can check out other CAD pairs on the basis of this tone from this rate session, but I don't expect any fireworks, but I'd lean towards CAD weakness on this. And last but not least, JPY, the yen. We do have BOJ rate decision where, again, these guys don't expect any fireworks. These guys are moving like a tortoise very slowly. They hiked rates, but have been unchanged for a while. They haven't hiked since December, January, and they're going to be unchanged for a long time. Given the recent language that we've had from Ueda, the BOJ governor, we've seen when you look at yen inflation, some of the data is not in high impact, but it's noteworthy. Yen inflation still not where the BOJ would like it. There's signs of it cooling. Let's just go back and look at wages as well. Look, core BOJ core CPI 2.3%, Tokyo core CPI cooling there on a year-on-year. Where are the wage figures? We had some wages not long ago as well. Wages from Japan, okay, which are not coming up now. Typical, just as I'm trying to go through. But basically, yeah, we had wages cooling as well in Japan. So it's not where things need to be. And markets at the moment are pricing the expectations of rate hikes for March 2026. Maybe it comes even later. So that's why yen has been an underperformer when you look, generally speaking, across the board versus a number of peers. I would be careful with UJ just because of the potential dollar weakness as well. But generally speaking, when you look at a lot of the yen pairs, we're grinding to the upside because of that dissatisfaction from the markets that we're not going to be getting these rate hikes for a while from the BOJ. Okay, and they are going to be in pause. For example, look at euro yen. The structure has been so clean to the upside with these higher highs, higher lows, and we just had this period of consolidation which we're breaking out of again to the upside. You can see where we want to head to these highs here of last year of 2024. So expect some further potential disappointment if these guys just remain on wait and see mode and, push back rate hike bets, and make that very clear because I'm so used to saying cuts, rate hikes. If they push back on rate hike bets, okay, make that very clear. The next move from the BOJ is hiking rates, not cutting rates. But if they let the markets down again, then yen bulls are just gone away anyway, but yen bears will come out to play and really sort of push some of those yen pairs, continue to push them to the upside. So a week once again filled with a lot of economic events. Guys, have an amazing and blessed week, and I'll catch you on the next update.